Welcome to the Money Talks for Beginners podcast. My name is Frankie Ho, a money nerd. Each week you'll hear me talk about different ways to use money more effectively in your daily life to become a smarter finance person. Thanks for spending your time with me today. Now let's talk about money. Welcome to the 12th episode of Money Talks for Beginners. Today we are going to talk about how to use technical analysis in order to identify when to buy and sell stocks. As last episode we talked about how to use fundamental analysis to find quality stocks. Today we're going to talk about how to use technical analysis to identify when to buy and sell stocks. So this episode we are going to cover all the technical analysis terminologies and tools that are most commonly used by technicians or technical analysts, short-term traders, and long-term investors. So after we understand what are all the terminologies and tools that are most commonly used, you should be on the same chart as everyone else. So when people are talking about how they analyze their charts, you'll be on the same page as all of them and you'll know what they're talking about too. There are actually four main areas we are going to cover in terms of our technical analysis parts. First part, we're going to talk about the type of charts that are out there and the time horizon, as each time horizon represents a different time frame that you're using in order to buy and sell different types of securities like stocks, forex, and commodities. Second, we're going to talk about moving averages, which is one of the most common technical indicators or technical analysts that are out there. Third, we're going to talk about oscillators and other indicators that are commonly used by technicians and of course other types of traders and investors. And lastly, we're going to talk about what are resistance, support, and pivot points. So of course, after we talked about all this stuff, we're also going to use a 1-year chart by looking at a stock called Tesla. I'm pretty sure we all know what our Tesla is. After we cover all the terminologies and tools in order for us to look at how to read Tesla, the 1-year Tesla chart, so you have a better idea of what is how to use all the tools and terminologies. So as I mentioned before, technical analysis is the study of chart reading where people attempt to determine when to buy and when to sell their securities, like stocks, forex, and commodities, in order to make profits or to prevent loss by looking at past price and volume actions. A lot of these people, of course, as I mentioned already, are mainly using technical analysis or chart reading in order to determine good entry points to buy and to sell in order to maximize potential future profits and to reduce potential future losses. So first of all, let us go to the first one called the types of charts. So first of all, you need to know what type of charts you are going to use in order to read your charts. And of course, you also need to know what time horizon you are using in order to identify what type of trades or investments you are making. So for example, if you are a day trader, of course you're going to use a daily chart in order to identify when to buy and sell. If you are a swing trader, you might use a quarterly or monthly chart in order to identify when to buy and sell. And if you're an investor, usually you use a chart that has a time horizon usually ranging from 1 year, 5 years, or maximum, depending on how long you're actually planning to keep a stock. So adjust your time horizon to how long you're thinking of actually keeping the stock. If you're a long-time investor, most of the time you just do minimum at least 5 years chart to see when to buy and sell, or a minimum at least an annual or 1-year chart in order to identify when to buy and sell your stocks or securities. So in terms of different types of charts, there are 4 main types of charts. There's the bar chart, which is called the OHLC bar chart. This type of chart tells you what's the opening price, the highest price, lowest, and closing price on the bar, which usually is represented by one vertical line and 2 horizontal lines are sticking out. The 2 horizontal line, the one on the left represent the opening price, the one on the right represent the closing price, and the vertical line in between represent the range that's for that day. The line chart essentially and the area chart is less commonly used, so I'm not going to talk about them. But by far the most commonly used chart is the candlesticks charts by most technicians, short-term traders, and long-term investors. So depending on your country, the candlesticks, which is the main body part, is either hollow or is colored in. So in I'll just use North America because I'm from Canada. Green represents usually an up day, and a red usually represents a down day. So for the candlesticks, I can't really say it's super easy to read, but I'll just try to explain it as best as possible for you guys. So in terms of the body is pretty much the colored in part of the candlesticks. And as I mentioned, in North America, if it's an up day, it's green. If it's a down day for that stock or security, it's red. So if it's an up day, that body would be green, and the lowest part for the body would be its opening price, and the highest point on the body, which is still colored in, is the closing price for the stock or security. Now, on the candlesticks, there are two vertical lines that literally just are lines. One is coming out on top or above the top part of the body, and there's another one on the bottom that's coming out from the bottom part of the body. The one that's on top of the upper part of the body, it usually represents the highest price for the stock, and the one on the bottom represents the lowest price for the stock or security for that day or quarter, depending on the time horizon for your chart. Now, it's great that a single candlestick can tell you so much information regarding: did you make money, did you lose money, what was the highest point, the lowest point, and essentially that's all great. But the main purpose of a candlestick is actually by combining different candlesticks over a long period of time, it can help you determine different patterns that it's giving off, that can help you further tell you if the stock price trend is either going to continue, reverse, or stay sideways, or is it bullish, is it bearish, all that stuff. So it's actually quite useful to understand how to do candlesticks, and we are actually going to talk about candlesticks patterns and dojis, and how to actually read candlesticks in order to help you improve your technical analysis further in the next episode. But today we're just going to cover all the basics for technical analysis first. So right now we just covered first one's called type of charts / time horizons for charts. So next we are going to talk about moving averages. Moving average is one of the most commonly used indicators on any charts by using past price actions to create lines that are moving based on the average of past price actions. Like the 5-day moving average uses the last 5 days price to get an average. 20-day moving average uses the last 20 days price average in order to get the average for the 20-day, and that will form different lines and etc. So if it's 200 days, it will use the last 200 days. Of course, let's talk about business days here because stock market is not open on the weekdays. However, the moving average you use also depends on the time horizon you are using for the chart. Like for a yearly chart, of course, it will make sense for use a 20-day, 50-day, and a 200 days moving average to determine the trend. But if you're using a daily chart, maybe it's not the best idea to use a 20, 50, and a 200 day because it might be too long for you. Instead, maybe use a 5-day chart, a 5-day moving average, 10 or 15-day moving average, and a 20-day is plenty enough for most day traders because you're not really focusing on long term, you're focusing at now. You're focusing on trying to make money as soon as possible. So now, what is the whole purpose of using the moving average? Even though it's most commonly used indicator, technical indicator out there, but why is it so popular? So the reason why moving average is so popular is because, first of all, it's relatively reliable, even though the information is a bit delayed because it uses the average price of the past 5 days.